Hello and welcome to this week's On the Spot. I'm Zach Strickland, here with, as usual, John Paul Hampstead, our Director of Passport Research, here to talk about the freight markets and what we're seeing right now. And of course, this is the traditional summer peak season. We're seeing, rapid tightening, tender rejection rates over 12% for the first time in a long time, tender volumes expanding wildly as well. So, it's been an interesting week, JP.
Yeah, I keep hearing some people say, but isn't this just a normal seasonality? But, at least compared to 2019, things are much more amplified. The magnitude of the swings is greater. And in general, ever since March, markets have been much more volatile than normal. So last year, right before the July 4th holiday, outbound tender rejections peaked around 6.2%. Now they're about 12.2%, and we have another week to run before the holiday. I want to say that OTVI is above 12,000.
Yep, it is 12,300.
This is an extremely high number for national volumes. And really, we're seeing broad-based spot rate inflation and capacity tightening across the country. It really started a month ago in Los Angeles and has continued to that tightness is kind of spread through the country. I think first in Dallas and Atlanta, but now it's Harrisburg is tight. Tons of regional markets are tight. I think Miami has like a tender rejection above 9% or something.
Yeah, tender rejections pretty much all over the country are up right now, most places for sure. And I think one of the interesting aspects of this is that we saw volumes really lead the capacity reduction yet again, whereas in March, volumes just surged and they almost turned on right away. We saw tender rejections within a matter of days follow. This it felt like about a few weeks before the tender rejections really started pouring in. And I think that was a product of the fact that we had, carriers really not sure about whether or not the market was going to recover. Right. They needed to make sure that they were adhering to their route guides as much as possible, servicing their accounts, their contracted freight as much as possible. And I think that they were just gobbling up as much as they could because they had just had a month and a half off, really to think about whatever they wanted to think about their life.
So in the stock market, you would say that it was like a hated rally, like it was a rally that no one believed in.
Right.
Right. But eventually, the carriers gained enough confidence, I think it's also part of the story here too is that shippers continued to test contracted rates by tendering loads, perhaps below prevailing contracted rates. That also slowly caused tender rejections to grind upward, and it was it happens slowly, and then it happens kind of all at once, right?
Yeah, I think this was really just when you're talking about carriers needing to get that utilization up, they're just really they're willing to deadhead 200 miles, 250 miles in some cases. Some of them may even go 500 miles to deadhead and get the freight. And now I think they're finally figuring out they don't have to do that. They can simply just say, well, I'm going to go service this freight 50 miles away or 20 miles away versus trying to really adhere to a lot of what my route guide says, which is, right. From a business standpoint, you have to do that. You can't just...
And their networks are thrown off anyway just because of the sort of uneven performance of shippers and the uneven demand in the goods economy. So what if maybe they had set something up to where they had a backhaul, a reliable backhaul, getting them back to their main, contracted account and getting their asset back in position. That fell away. They were deadheading to do it or trying to figure out something else kind of on an ad hoc basis. But now they're just rejecting it.
Yeah. And again, the tender volumes that we're seeing now, they would have, really correlated with more of a 14, 15% tender rejection rate versus where it is now. So there's still room to grow on the tender rejection rate, especially if you're looking at the March relationship between tender rejections and tender volumes. They almost lined up exactly with their movements. This one, not so much. It took a lot longer. We took about 2 to 3 weeks before tender rejection rates really started to increase with any significance. And looking into July, are we going to continue to see this seasonality? And I say seasonality in a more traditional sense of trend line analysis, not necessarily pattern. It looks, we've broken pattern for sure. But you look at traditional seasonality, and we're talking about a June market that's typically one of the more robust of the 12-month cycle.
Oh yeah.
And traditionally, July softens sequentially.
July softens, and then you see a ramp in late August and September.
Yeah, and I mean in August and September.
And it kind of depends. Sometimes August is a good month if that ramp starts earlier. Sometimes it's a bad month, and you just see a September bomb.
Yeah, there's less seasonality in that August September. It's really hit or miss, and that's dependent on the overall economy a lot of times. But whether or not this continues past July 4th, I do think that we'll continue to outperform 2018 for a little while, at least in the early part of July.
2018.
Yeah, I think we'll still continue to outperform 2018.
Or 2019.
2019 for sure.
Okay.
I mean, it's going to take a minute.
Interesting. That's fascinating. I mean, I think what my team is really looking at with regard to July is just how does capacity react in relative to volume. Mm-hmm. So if volume goes down, but things stay tight, that's like a flashing red sign that Q4 could get really wild.
Yeah.
And there are other variations of those moves. If volumes stay steady, but rejections continue to ratchet higher, obviously that's tells you a lot. So that's kind of what we're looking for. If we see a sort of a correlated down movement where both volumes soften and rejections ease a lot, then that kind of tells you that maybe things are more normal than they seem, but I don't know if that's going to happen.
Yeah, we were talking before the show, of course, about how this new, freight market pattern is really divergent from what we've seen in the past. A lot of the relationships have broken down a little bit. Those correlations, not necessarily as one-to-one as they used to be, or inverted, whatever you want to call it. And in my view, I mean, we're talking about things like the ATA's truck tonnage index. It was down in May. OTVI was up slightly in May. There's this debate over whether or not May was, a recovery month, but the OTVI was still down like 4% year over year in May. So it's not like, a significant divergence from traditional patterns.
I think to your larger point, people are just having an actually fairly robust conversation about data and data indexes that are often quoted in the industry and maybe haven't been questioned or scrutinized that closely in years past, but now there's so much confusion in the market and there's so much divergence between how different players in the market perceive business conditions that the data is really being looked at. And I think there are actually some really good high-level discussions happening on LinkedIn and other forms of social media and just out in the industry and in virtual conferences more broadly. So I think that's like really healthy, and it is a confusing time too. But
well, I mean, this is why this is really healthy. I think this is actually extremely valuable because now we can actually break down what these actually measure. I mean, you're basically looking at something that calls itself a tonnage index. Is it truly measuring weight? Is that what it's measuring? And I mean,
does weight matter?
Yeah, does weight matter at this point?
How much does weight matter for?
And the reasons that it
truckload
could divert from other indexes is for two reasons. It could be weight, which weight for if you're measuring weight versus shipments, that's not a one-to-one. That's not a connected measurement. It's not apples to apples.
You're measuring weight versus dollars spent.
Yeah.
It's not connected.
It's not the same denominator.
You're measuring the weight for compared to truckload, it's not connected. If you're measuring weight compared to truckload rates, it's not connected.
And the traditional freight mix has been thrown off extensively. And one of the things we were talking about before the show was the fact that you don't necessarily need like robust retail sales or industrial production to have freight movement. Those are kind of like early cycle and late cycle. In terms of the stream of freight, they're kind of like end point and beginning point numbers. there's a lot of stuff that happens in between that, such as inventory repositioning, which is something we've seen a ton of in the last 2 years, really, with the trade war, starting a lot of that, supply chains really being disrupted.
Yeah, and to the extent that a lot of retail freight is seasonal and inventories have to be turned over to actually generate sales,
Right.
Like people buy different kinds of things in back to school than they do in February and then they do in June or that they do in December.
Yeah.
And so like a lot of the movement in demand for transportation occurs well before significant movements in actual retail spending.
Yeah, a lot of shippers will, obviously get freight into position ahead of demand because they're forecasting demand. The problem with right now is that they didn't forecast a lot of the demand that we're seeing right now. Obviously the world has changed in the last 3 months. People are buying different products. Grocery is now leading restaurant and commissary type. We're consuming things much differently. People are buying up home improvement. Real estate is going haywire. Home sales are going haywire still. Construction, still a big thing right now. So it's not that the traditional patterns they just don't look the same because they're spending money in different ways. They're behaving in different ways that doesn't necessarily flow through the same exact channels.
One thing has remained constant though. They're spending every last dollar they have.
Well, savings is up a little bit.
Yeah, savings, I should say that retail savings for lower and middle income, retail spending for lower and middle income has recovered a lot more than retail spending for higher incomes.
Yeah.
One last thing I did want to touch on was just my team has put together a Q2 3PL earnings preview. I mean, we're not like predicting earnings, building financial models, setting price targets, or offering investment advice, because that would be wrong. But what we are doing is kind of saying like, okay, given how these companies are set up, how management has said that they're going to operate in the market, given their 20 years of historical data, of their financial data correlated to freight market data, how do we think this quarter shaped out for them? And what's really interesting is that in April, on their Q1 earnings calls, everybody was saying, oh, this is great, capacity is easing up, rates are falling, our margins should be widening. Well, they were pretty much saying that at the bottom, and everything reversed from there. So volumes went up, not necessarily contract rates.
Right.
Spot rates went up, and capacity tightened. So we actually think that, and when you take all of the, you take the national average spot rate for Q2 2020, it's actually higher than the average spot rate for Q2 2019.
Right.
You factor in on average, a lower contract rate for 2020, right? Because it was negotiated in 2019. Narrower margins.
Yeah.
Narrower margins on perhaps higher volumes by the time you get to May and June, or June especially.
Right.
But yeah, it's interesting. I think some of the 3PLs will probably talk about how they improved their mix toward contract away from spot, right? Because there wasn't any spot freight. But that's actually where they're getting squeezed, is on the contract freight now.
Yeah, it's got to be extremely difficult for the brokers to navigate this level of volatility. I think normally they like the volatility, but this is unprecedented in the way that we've flopped the market now 3 times in the last 3 months. Normally we have 3 months to deal with these inversions.
Right.
But now, of course, they're going to have to deal with increasing spot market.
It's going to be
pressure.
interesting. And I think one last thing, to the extent that they are able to maintain or widen margins, it'll be because the scale of a C.H. Robinson or an Echo or a J.B. Hunt enabled them to push rates further down in April than national average, and keep rates from rising as much as the national average in June. And so I don't know, their much vaunted buying power, if that's really a thing. I guess we'll find out when they announce the results.
I mean, with the carriers, the way that they've obviously negotiated lower contracts for this year, they're going to have a lot of trouble, keeping those margins elevated and making money, even with an elevated spot market, because it's going to take another while for those contracts to get any pressure on them again. Well, thank you so much, JP. Thank you for watching, of course. Stay tuned to FreightWaves Live, freightwaves.com for any future freight market updates, and have a great week.